completely different from when we started, you know. But I mean, we started with an online brokerage account. Hello everyone, this is Rowan in Blue, just taking my daily walk here today. And today's topic would be on investing with very little money. So when it comes to actually investing, it isn't as difficult as you might think. You don't necessarily have to be the wolf of Wall Street to start investing. You can be the mouse of Wall Street, and it'll be the same situation, but just with a lot less money. But you know, it's all about really a little bit of discipline in your savings habits, and making sure that a small percentage every paycheck is put towards saving, so you can put those that extra money there to direct it to a brokerage account. So if you keep that habit on a routine basis, then you can definitely take advantage of compound interest. So it's all about, you know, selecting the right stock and just going ahead and gaining yield from that particular stock on a monthly or quarterly or yearly basis. So I'm talking specifically about dividends, but of course there are other options you can choose as well, such as index funds and mutual funds and ETFs, and having a percentage of each, diversification. And you can have dividends. It's a little bit more complex, I guess, in selecting individually selected stocks, but then they probably give you the largest yield percentage if you do. But you also have REITs as well, real estate investment trusts, where you can invest into real estate without actually having to have physical property that you have to manage. But we have a little bit of both, of everything. We have a pretty good recession-proof portfolio that we can say with confidence that it has been working quite well for us, especially during this pandemic. So we're really happy to share some of the points that we have used over the years. And you don't have to start with very much at all. So like I said, it's just about having a bit of discipline, right? And maybe you want to stay away from the baristas, getting those Starbucks coffees, and then, you know, instead of paying that $5 cost of buying that cup of coffee, you can just save up. And it's really worth having to grow your net worth from a very young age, so you can start taking advantage of compound interest. So, I mean, you're looking at, let's say, if you can find yields of between 6 to 7%. Usually REITs are pretty high as well. But I'm saying 6 or 7% because most of the companies, when you do first purchase them, start off with a lower dividend yield. But over the years, if the company does well, and the company wants to stay ahead of inflation, then they usually tend to raise the yields over the years as well. So you're looking at maybe first starting off with a yield of 4% when you initially invest, but over the years with compound interest and the companies increasing their dividend yields, you can easily hit 67%, 6 to 7%, not 67%, but like some of our stocks that we've had for over a decade, we have yields of over 10%. And even during this pandemic, they're still giving out the dividends. But when we first started, we didn't really have too much money. We're probably just like you, where we didn't have, you know, those large incomes in the beginning anyways. It's a step-by-step process, of course, you know, through your career, whatever career that you have. In most cases, people get raises, and But the problem is, most people who get raises, they try and upgrade their lifestyles, getting the larger home or the better car, or the better gadgets. But we actually chose to not do that. And whatever surplus that we got from our raises, as well as our tax returns, always went into investing. So, which made out to be a very good decision for us, because we actually went the route of achieving freedom other than having a lot of stuff. So, but because we figured, looking at some of the examples I saw over my lifetime of people buying stuff and just storing it in their garage or their attic, collecting dust, it didn't look very efficient for the usage of your money. So there's a number of books that we read over the years as well, and they inspired us to start investing. And I'm really glad that we did, because it has led us to financial independence. We're starting with very little. Especially right now, it's actually a lot easier to invest because, well, it's so convenient nowadays. You can swipe for anything, right? It's in the year 2020. You can swipe for making your purchases of coffee, of pretty much anything off of a card. And they actually made it really easy to invest now, where you can swipe. Well, I wouldn't say swipe, but you can still make your purchases using certain apps out there. But I'm not gonna, there were a couple of companies that have contacted me to advertise their products, but I'm not really up to that point yet, I guess. But there are a lot of apps out there, you probably know as well, and where you can start your investing as well. So it's completely different from when we started. But I mean, we started with an online brokerage account. We signed up for it. It probably took about 2 weeks for them to approve us for it. And we finally done online. But back in the olden days, I would say, 40, 50 years ago, you used to have to go to a physical office, and there was a minimum amount of money that you needed. I believe it was around like $50,000 to actually open up a brokerage account. So you can consider yourself being very lucky nowadays, because you can just simply open up a brokerage account right there in front of you using your smartphone. So you can start with very, very little. We've actually gained experience to the point where we have our individually selected dividends. So we manage that all ourselves. So the only time that we have to worry about fees is when we purchase it and when we sell it. So, but meanwhile, we buy and hold. So we just accumulate the compound interest off of the yield for the companies we select individually. But you can definitely use robo-investing as well. That's something that definitely wasn't around when we started to invest. But you can simply have the AI select the stocks that are trending. And of course, I day trade as well over the S&P 500 E-mini zero-sum markets. And I have to compete with the AI every month. And I always consider maybe switching over just to make it automatic. But something about having to let AI do the investing for you, I'd rather do it myself. But I've used robo-investing before. I have a small amount in a separate account there, just as an experiment. And actually, it's actually doing quite well, surprisingly. And I had a thought in my head that I should have put more into my account to grow it. But just know that there is robo-investing as well. It's a lot cheaper for you to invest into, and you won't have to deal with an advisor other than the AI. But you'll definitely find that over the weeks or the months of money that you save and invest, it becomes addictive. And it definitely was for us. It was a game on a monthly basis together with our savings savings rate that we had a savings rate of roughly about 50 to 60%, and with that extra savings we always invested. So it was, like I said, it was always like a game. It was fun, and it's actually still continuing today in financial independence. All of the surplus that we get, we go ahead and invest it and grow our net worth even further, even during this pandemic. Well, obviously you can see at this time that there's a definite disconnect between the stock market and Main Street, where all the jobs are. So there's always ways to manage. Historically, there has been people in the past who have become millionaires in situations such as these, in recessionary periods. And we all know there's going to be recovery. I definitely know there's going to be recovery. So with that mindset, you want to discipline yourself and keep saving and investing, live below your means. I think a lot of people right now are saving anyways. Like, it's forced savings at this time. Savings rate on average before was 6.5%, but it actually skyrocketed to over 20% on a monthly basis for the average American. So it's with that extra surplus, I would highly suggest you don't buy all the sales that they have right now, materialism. All of the non-essential stuff is, there's deals everywhere, sale, right? But other than buying stuff, I would put that extra money into buying stocks instead, and you'll see that it will benefit you later. Buy now and then accumulate and buy stuff later. Yeah, it's as simple as that, really. But you can temporarily use, I like to call the debt weapon of frugality and minimalism, which worked out great for us. Questioning everything that you purchase, that you buy is also an opportunity for you to save. So, and you might even want to, take into account of all the stuff that's lying around as well in your garage, your attic, that's collecting dust, that might still have some value. You can use platforms such as Amazon and eBay and Etsy, a bunch of other applications you can use to sell your stuff. So it only takes a bit of time to, package it up and send it to whoever wants to buy the stuff that's sat idle. So it's better for, that product there to sell it and make money off of it, and then to make money off of the money that you invest into. But what you can use is one technique would be the cookie jar technique. So just how it sounds, you just have a jar, and let's say you put $10 in there every week or something, and by the end of the year you'll have about $500. So you just have to, it's a very little amount that you have to worry about on a monthly basis. $10 isn't much. So yeah, you just do that with the intent and not to touch the cookie jar either, and just let the money accumulate. And by the end of the year, you invest $500. And it turns out if you do invest that amount, then you'll get $2.50 roughly a month by investing $500 on a monthly basis. But you'll be getting $2.50 a month for doing nothing but holding your funds. There's a number of different methods you can use. You can just create a separate account to accumulate the $10 and make automated payments of exactly $10 into that account. Or you can go old school, and you can use like the envelope system, where you have this white little envelope and you just label it as savings towards investments or something like that, and just put $10 in there routinely every month. So it keeps you motivated as well whenever you see that envelope. So, but the disciplined part would be to try not to touch that envelope or that personal account, or you can even make it so it's inconvenient for you to get to, like a personal account at a different banking institution or something like that. So it's hard for you to withdraw. So, but then making it automatic is an excellent idea as well. So it's not actually you who's putting the money in, but the system just automatically takes that money and you pay yourself first. So that's essentially how it works. But I think I end my vlog here today. Tell me what you think of all of the points I talked about in possibly starting to invest with very little money in the comment section below, taking advantage of compound interest. So the earlier you start, the more you will gain exponentially towards your retirement fund. But if you like this vlog, please don't forget to give me a like, subscribe if you haven't already, and hit that notification bell for more of my coming content here. Thank you for watching my vlog. Be free, gain wealth, and travel far.